Trading around value is a really important concept because this makes sure that you don't overpay. This makes sure that you don't sell in the hole. So when you look at professional traders, they're always fighting for the execution. They're always trying to buy as cheap as they can, sell as rich as they can. And that's because they know that if they can buy low, sell high, they'll make more money. Always trade value. Buy low, sell high, and use positive reversion to trade. So let's get into it. One of the things I always say is people talk about mean reversion, but they actually don't quite understand how mean reversion works. The market always reverts to the mean. It always reverts to the mean. The question is what type of reversion is it going to be? The mean reverts two different ways. When people think of mean reversion, they think of number one, which is price reverts to the mean. This means the market gets really overbought and then the market collapses and goes back to the mean. Prices fall or prices rally if the market's been breaking. So the price goes back to the mean. The second way is the way that people don't talk about, and that is that the mean catches up to price. What this means is the market may be overbought, but then it goes sideways for a long period of time, waiting for the mean to catch up. When the mean catches up, then the market starts to go again. This whole concept of the mean and trading around the mean and how prices move around the mean lends itself to cycles. Now, there's cycles out there that, frankly, I think are bullshit, but there's some cycles that we do use, and the cycles we use really revolve around this concept of the mean and the concept of mean reversion. So it's important to understand both of these patterns and their implication on how we manage prices. If we think we're going to revert by going back to the mean, well, that's one behavior and we manage it one way. If we think that the mean is going to catch up, we manage it in a different way. But understanding these two ways gives us a better sense of how to manage trades. So now we mentioned this concept of positive reversion. What is positive reversion? Well, we're talking about mean reversion. Positive reversion is when you buy below the mean and you sell above the mean. In the market making realm, market makers are always talking about trading for edge. So they have some type of model, they have some type of theoretical value and then they buy below that value and they sell above it. And they try and do that as many times as they can. Every time that they can buy below fair value, they've collected an edge, the difference between what they paid, what fair value was. When they're able to sell above fair value, they collect an edge, the difference in price between where they sold it and where fair value is. So when we have positive reversion, we're buying below value, selling above value. Negative reversion is just the opposite. In negative reversion, we buy above value and we sell below value. So we're actually giving up an edge. So again, in the trading realm, market makers tend to get edges to trade. They buy on the bid and they sell on the offer. And the customer, like you, the customer, to be able to execute your trade, you need to buy at the offer or sell at the bid. So you give up a small amount of edge. Everybody talks about what they spend in commissions, but in a lot of cases, the edge you give up in reversion is oftentimes much bigger than the commission. But one of the questions you want to ask yourself is, are your trades positive reversion trades or negative reversion trades? Most traders have no freaking clue what they do or which they are. So when we understand this, we understand that we're trading around value. This trading around value is a really important concept because this makes sure that you don't overpay. This makes sure that you don't sell in the hole. So when you look at professional traders, they're always fighting for the execution. They're always trying to buy as cheap as they can, sell as rich as they can. And that's because they know that if they can buy low, sell high, they'll make more money. This is a schematic from a book I absolutely love called Alpha Brain by Stephen Denier. And one of the things he shows is that when you have a fair value and we use positive reversion, what we want to do is we actually want to sell if we're long and value's going higher. We want to sell just inside the upper band of fair value. So we essentially have a fair value band. We have fair value in the middle, and then we have statistical bands on either side, a statistical sell band, a statistical buy band. So we sell just inside of the statistical sell band, and we place our exits just outside, our stops just outside the statistical buy band. So we use this expectation model around fair value to make decisions of where to buy and where to sell. So There's lots of discussions we can have about what is the mean. Well, the mean is subjective. One of the things I can tell you is you can adopt something simple. In this case, we're just using a 10-period volume-weighted moving average. A 10-period volume-weighted moving average. Very simple. It's in every charting package. And that's this green line. So one of the things we could say is, well, this is our mean. So if we're above it, we're above the mean. If we're below the 10-period volume-weighted moving average, we're below the mean, right? And so reversion to the mean would be if we get above it, we go back to it. You can see if we get below it, we go back to it. We get above it, we go back down to it. You can see the market's oscillating around this mean. When we get into a trend like we did here, market can stay away from the mean for a while, but it cannot stay away forever. One of the things we need to be aware of is where is price relative to the mean. People are unaware of this. So because of this, they're not aware of value. They have no value framework. You need to have a value framework for all of your trading. You need to understand what value is so you know if you're buying it cheap or too expensive. Where are you at on this? Do you have a value framework? Are you aware if your trades are positive reversion or negative reversion? You need to be able to answer these questions. You cannot be a pro. You cannot be a great trader and not be able to answer these questions. So that's going to be a wrap for today. This is Trader Tip Tuesday, where every Tuesday I come to you with different techniques, different concepts, different principles like today to help you take your performance to an elite level. See you next Tuesday.